Hi, welcome to On Investors' Minds. I'm Tai Hui, the Chief Market Strategist for Asia Pacific at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to learn about what is on investors' minds and how that fits in with building the right portfolio for you. Now, first of all, I would like to wish you all a very happy year of the snakes. 恭喜發財，恭喜發財. Now, in this episode, I do want to discuss three key topics as we return from the Lunar New Year holiday. Despite it being only the first month of 2025, a lot has happened in the markets. Now, these topics are the President Trump's tariffs against Canada, Mexico, and China, the latest market thoughts on AI, with DeepSeek acting as a catalyst challenging some valuation questions, and of course, the Federal Reserve meeting in late January, where rates were kept unchanged, but with a more flexible policy outlook ahead. So let's start with President Trump's tariffs. On February 1st, President Trump announced tariffs on Mexican, Canadian, and Chinese exports to the U.S. Tariff rates were set at 25% for Canada and Mexico and 10% for China, with some minor carve-outs for Canadian oil and gas exports, which are only taxed at 10%. Now, these tariffs threaten to raise prices and slow economic activities across all four economies. Both Canada and Mexico have announced retaliation, but they've all agreed to pause their tariff increase for 30 days to allow for negotiation, especially regarding border control improvements. China's reaction is yet to be observed, and there are questions about whether the U.S. can push China to fulfill the Phase 1 trade agreements from 2020. Now, the biggest risk here, of course, is an increase in inflation. Back in 2018, during first Trump administration, tariff increases did not lead to a substantial increase in inflation. However, this time the magnitude of the tariff increase is much larger. These three countries are the U.S. largest source of imports. Our calculation shows that the average tariff rates on U.S. imported consumer goods could rise from around 2% to over 8%, a level not seen since World War II. Now, this would encompass a wide range of consumer and intermediary goods, such as automobiles and machinery. Now, whether the supply chain can absorb these tariffs without passing costs to consumers is really a big question mark. Higher prices may lead to consumers also cutting back on spending, and we've already seen some low-income groups struggling with credit card and car loan repayments. Some uncertainties from these tariffs could also lead to reduced corporate investment. While Mexico, Canada, and the U.S. are negotiating, companies need to think long-term when it comes to investing. Historically, recessions in the U.S., except for the 2020 pandemic, were often triggered by cuts in corporate spending and investment. While we're not predicting a recession, but policy uncertainties could negatively impact corporate sentiment and economic growth, and that could lead to potentially softer growth in the second half of 2025. Reflecting on 2017-2018, the first Trump administration, the slowdown in corporate investment may not have been directly linked to tariffs against Chinese exports, but policy uncertainties did create a question mark on future returns, forcing companies to slow down. As a result, the Fed started to cut rates before the pandemic hit the U.S. economy. From that perspective, there could be parallels between the first Trump administration and where we are now. Now on to the second topic, AI. Now, DeepSeek released its model back in December, gaining attention for its powerful capabilities and lower operating costs compared to U.S. counterparts. This raises concerns about the rapid commoditization of AI by competitors from China and also other regions. Historically, the running and equipment cost of these models tends to decrease over time. DeepSeek is arguably part of this trend rather than the start of a new one. But its emergence has put a spotlight on this development and raises questions about the elevated valuations of hyperscalers. So thinking ahead about the AI industry, there are two important aspects. First, competition will rise. The competition within the U.S. amongst U.S. tech companies and also with international tech companies will continue, meaning that not everybody is going to be a winner. While we're still very confident that AI as an industry and technology is very promising and will deliver, not every company investing in AI today will be profitable or dominate the market in a few years' time. Just looking back at the tech sector developments over the past few decades, many companies had good ideas invested, but only few emerged victorious. The same logic applies to AI today, making active selection really critical. Secondly, as the cost of using AI decreases, the benefits to the broader economy will become more apparent. Sectors like financial services, healthcare, and consumer services can benefit from cheaper AI services, potentially leading to increased demand for AI. Now, this could result in a winner takes all or winner takes most scenario for tech companies developing these services. For the broader economy, companies can use this technology to protect or improve profit margins, which is a constructive outcome in the long run. Finally, on the Fed. Now, it kept policy rates unchanged in the January meeting within the 4.25 and the 4.5% range as expected, and also adopting a more patient approach. Now, given the recent policy announcement from the Trump administration and the resulting market volatilities, the Fed is wise to step back, assess the policy implications and also the economic landscape, and then decide on future policy rates. Whether tariffs are truly an inflationary force that could force the Fed to reconsider raising rates is still questionable in my view. Tariffs and policy uncertainties could create downward pressure on corporate investment, potentially leading to a broader economic slowdown. The Fed also sees tariffs often as a one-off event, unlikely to cause a sustained inflation that jeopardizes the 2% target. So the Fed may choose to tolerate the tariff increase for the time being if it happens, considering the potential downside risk from higher tariffs both domestically and globally. Ultimately, we still see the Fed having a rate cut bias, and if policy uncertainties and volatilities calm down later in the year, it should clear the path for rate cuts. So wrapping everything up, what does that mean for investors? On tariffs, we argued back in our 2025 outlook that service sectors should be more resilient as tariffs are mainly focused on goods. Financial services, healthcare, consumer services should be in a better position. Investors may also look to regions like India and Southeast Asia, where supply chain shifts are ongoing and potential benefits from diversification. As global supply chains become more complex, there's also going to be an increased need for shipping and also infrastructure as this global supply chain diversification continues. In terms of technology, we still favor US equities, which continue to show good momentum despite policy uncertainties. Now, when the DeepSeek triggered correction occurred on January 27th, tech companies took a hit, but 350 stocks in the S&P 500 index actually went up. This indicates that investors are discerning about tech companies with valuation questions while maintaining confidence in other parts of the economy. In the near term, a more neutral selective approach to tech companies may be wise while broadening allocation to sectors like financial services, healthcare, and consumer services, which can benefit from AI development, and meanwhile taking a bit of a hide away from the tariff threats, as we mentioned above. Finally, on the Fed, it is likely to pause until policy uncertainties clear up, which could take some time. Short duration fixed income remains a favorable option as bond yields could continue to whipsaw depending on what the Trump administration does. And default rates are likely to stay low for the time being. This bodes well for assets like high-yield corporate debt and also investment-grade corporate bonds, offering investors a decent carry despite tight credit spreads. Thanks for listening. If you enjoyed this podcast, please share this with friends or colleagues and also consider subscribing. If you have any topics that you would like us to cover, please reach out to our JP Morgan Asset Management client advisors. I'm Tai Hui. I'll see you in the next episode to discuss what's on investors' minds.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions, and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. JP Morgan Asset Management is the brand for the asset management business of JP Morgan Chase and Company and its affiliates worldwide.